Hey everyone, my name's Andy with the Finding Value Finance channel. I've got Scott with me today, the Sow and Reap Capital. Notice that he is wearing the same color uh, jacket with the same color shirt. This was not done on purpose. I guess great
Crazy.
minds think alike on starting off the week with a good week of wearing red shirts and navy blue jackets. So today we're going to talk about real estate. And there's stark differences between America's real estate and Australia's real estate, which Scott lives in Australia. I live in America. We have our own viewpoints, and we're not by any means real estate experts. I mean, we know the markets, we look at the markets. At least I look at the real estate market to get signals for certain investments and for inflation and stuff like that. I'm not, well, I'll say this. I probably know more than your average person that sells homes. Definitely there. But because I've dealt with realtors and I don't know, for some reason they don't know that much about the actual market that they're selling in. I don't know how that's even possible. But what we're going to do is we're going to go back and forth and talk about the differences between Australia real estate, the real estate in America. We're going to talk about housing affordability. Does it even matter? Maybe it does, maybe it doesn't. We have different viewpoints on it. And some people put a whole bunch of emphasis on housing affordability, while others, I think, put less emphasis on it. And we'll talk about all this different things, all this different stuff going back and forth, different metrics and whatnot. So Scott brought up that over in Australia, their housing market is way more expensive, like leagues more expensive than America. And he laughs at the payments that we have to make here in America. He thinks it's ridiculous. So Scott, what are you seeing over in Australia? Like, fill us in on what's going on over there.
Yeah, sure. All right. So this is a publication, a report that was published by one of the bigger banks here in Australia. So it's an ANZ Bank's publication. And so these are some of the key metrics. So this is for Sydney, right? So these are some of the key metrics that they published, and they include like value to household income to income ratio, which is right now sitting at 12.5 for your houses and 8.1 for your units. I believe in America, we're sitting around 6 to 7. Is that right, Andy? Around that mark in terms of affordability?
It highly depends on where you're at. In California, it's very high. In other places, it's really low. I bet some places it's probably only like 3. In other places, it could be similar to like 6, 7, 8.
Yep. And you were telling me just before that when you bought your house, it was trading at like 2 times your earnings or something like that.
Yeah. So,
which is like just unheard of.
Well, I mean,
oh my goodness.
It was like 2, 3, 4, depending on what size house you purchased. So mine isn't the median. Mine's a little bit more expensive. The reason I went more expensive is because I couldn't buy a medium priced house where I live, because there was like literally 15 to 20 offers that would just jump on the house. So I was like, I got to go above a certain threshold, because we have a lot of military here, and they get approved up to like $300,000 or something. That's what it was when I was looking. So like anything under 300 was like, it was like like if you win a game, everyone does this like big hog pile at the end of the game. That was like what it was. Like a house would go up, then you go, and they just all jump on it. And I couldn't compete. There's too many offers. So a house would go up 257 and they'd bid 297 on it. I'm like, oh God.
I mean, just to be hearing about like $200,000-$300,000 houses, that's just crazy for me, because I think I told you I live in Sydney, but quite far from the city, so quite far out. Like it almost takes like an hour and a half to get into the city, right? So, and where I live, obviously I'm not going to disclose where I live, but where I live, like units go for $1 million. Like units with 2-bedroom units go for $1 million. Like 4-bedroom houses go for 2.5 for up to $4 million for a 4-bedroom house. To be hearing houses like, I mean, prices like 200,000, 300,000, it's just insane. I think I saw those type of prices when I first came to Australia, which was back in like 1996 or something.
Yep.
So yeah, that's insane, right? 25, 30 years ago is when we saw those type of prices here in Australia. But yeah, so you've got the value to household income ratio here, it's 4.5. But what's really mind-numbing for me is the proportion of household income required to service a new mortgage, which is sitting at 60.4. And I think we've looked through this report and we might be wrong, but I think we're talking about the gross income.
That is insane. That's absolutely insane when I think about it. But the
Yep.
the question I have is, and I've seen this
Yep.
when I lived in California and other places, is
Yeah.
how important is the affordability of the homes? Like that's really the question. And I don't have a good answer, and I don't know if the calculation for affordability even matters. Does it? Or what's your opinion on that?
I think it matters. So the reason why I say that is, so you've got obviously the bunch of people that position themselves really early in the market, right? So say for example, in America, like that's different, right? But in Australia, obviously we've had rising house markets, and what you see here is owner occupiers and investors. So what I'm trying to find is first home buyers, right?
Mhm.
But hold on. Okay, so the reason, I'll just briefly explain my reason for why I think it matters. So you've had a bunch of people that newly came into the housing market. I've got lots of friends who just entered the housing market for the first time, for example, that are in the market. I know how stretched some of them are in terms of their mortgages, and it reflects this figure here. I know they're spending bulk of their money paying off their mortgages. And for those newcomers that have bought at those high prices over the last 5 years, for example, right? When interest rates hit them and they're already maxed out and they're already at their peak capacity in terms of capacity to repay their mortgages, I think a lot of them will be forced to sell. So if you have a case where a lot of these newcomers to the housing that bought it at very expensive prices, historically very expensive. If you look at all these figures here, like years to save a deposit, 16.6 years to just save a 20% down payment, right? So if you look at all these figures and ask yourself, what's going to happen to all those newcomers that bought it at really high prices in the last 5 years? What happens to them once the interest rates start rising? Because they already maxed out in terms of capacity to repay. So if you think about it from that perspective, I think it does matter.
But in Australia, you guys have a completely different loan,
Yes,
the way the loans are set up and structured. Can you describe real quick
Yes.
how they're structured and what maybe how it's set up?
Yes, and in Australia, that's why I think it matters, because the longest period for which you can fix your loans is 5 years. So that's the longest time in which you can fix your loans. I know in America you can fix it for the entire 30 years, but in Australia, the rising rates will actually hit all the mortgages because of the duration of the fixed loans. And I know, like, just talking to friends and I'm sure I can find the stats somewhere as well, but I know a lot of them have gone variable. I know a lot of them have only fixed in for 2 years. And so, 2 years down the road, when their fixed mortgage rates expire and they need to go on variable mortgages with much higher interest rates, I know those payments, those rising rates will actually impact them quite significantly. So
I think I just tied something together here. I'll kind of verbalize it.
Okay.
If you notice,
Yes.
every time we enter a bull market in commodities, we have a rising dollar kind of in the beginning, right? And then towards the middle end of it, we have a large declining DXY dollar. Do you think that has something to do with rising interest rates in different currencies, and it impacts housing more in your guys' currency than ours? So it would strengthen your currency if you guys have a weak housing market, and it would weaken our currency in relationship to yours, because when your guys default or you have almost like a housing problem, it puts different pressures on different areas differently. So we would still be booming in our real estate market, but everywhere else, if they have loans structured like that, could slow way down. I mean, I'm just kind of guessing. It's not a fact. I haven't dove into it yet, but and then okay, so you think affordability matters. affordability matters because it's the new entrance. Now, here's my question here, and I think it does matter over there because I see years to save a deposit is 16.6 years. That seems pretty ridiculous. So my question that I would ask most people would be is, why don't you just save longer? Why don't you just save a bigger down payment? Why would the house price have to collapse to the affordability, or couldn't the affordability be managed by larger down payments or by gaining larger payments from parents or whatever it is from other sources? Like, could that sustain a higher market where the multiples of an income could be much higher, but you're just saving longer? And I think that's what's happening over in Australia.
Yeah, that's what it's been happening. So I don't want to call a top in anything because you know me. I just look at the money flow and I just react to the money flow. But I think it's probably not probably not the ability to save the deposit that will matter. I think what will matter is what's going to happen to the people that bought houses at these peak levels that are spending 60.4% of their total income in mortgage repayments, and suddenly when they are hit with the rate rises, what's going to happen to all those houses, right? They're going to maybe there will be some forced selling, and that's what could drive down the prices, right? So,
for sure. Yeah, that I totally agree with, definitely.
Yeah.
Yeah, I was just thinking because I used to live out in California in San Luis Obispo, where I went to college, and I think the medium income there is probably $40,000, $50,000, but their home prices are, I mean, a decent house out there right now, and that's probably what the medium income is now, is like 900,000. And like really nice ones are like 1.5 million, 2 million, 3 million. There's a whole bunch. And there's no one there, if you're making the medium income, that could afford a house. There's none. And you could save and save and save and save, and I don't think you could get into those homes. So I'm just using one example. That's one example. And then I start to think, well, does affordability even matter to the medium income of the local area? My answer is probably no, because eventually you run out of good places to buy homes. Like all the top areas in the entire nation will get purchased quickly, I think. And it's just money. You can make your money in a big city, like make a whole bunch and then move and buy that low cost area place. So all of the locals will get priced out of their own homes that they can potentially buy.
Yeah. So that's exactly what happened in Korea. So there's a little island in Korea called Jeju Island. It's like a tourist area, like really nice island surrounded by ocean. And like basically all the people that made their money in the capital city Seoul, they moved all their money to Jeju Island, and and also Chinese came and bought the land as well. So it really spiked up the price of the land in that particular island. So that could definitely happen. But I guess we're talking about like Sydney and New South Wales. So New South Wales is a state within Australia. And so you're talking about the whole state being overvalued. So I don't know how like rich people from other states, because obviously we're the state with the highest income in Australia. So I don't know how people can bring in money from other states into New South Wales to prop up the house prices. So yeah,
I understand that.
I think you said it correctly, is that it's the biggest difference between the US housing market and the Sydney or in the Australian housing market is really the fact that you can fix your mortgage rates for 30 years. So I can totally see that in America, for example. Why would you sell your house now, right? So there's going to be no inventory now because the rates are going up. So anyone wanting to swap your house right now will be going into potentially a same house, paying a lot higher price for it in terms of your mortgage payment. So it doesn't make any sense for anyone to sell unless they want to like move to a different state or different city or something like that. But in Australia, it's different because you can only fix it for 5 years. And I know a lot of people have variable mortgages and 2-year fixed rates. And so the impact of the rising rates will actually kick in a lot harder. That's what I feel. Another key differentiator for me between the American housing market and the Australian housing market is I'm not a housing expert. I don't really take too much of an interest in housing markets, but I know for a fact that US had a cleanse out in 2008, right? Which means you've totally and completely started with fresh books in terms of your mortgages. So anyone who bought a house between 2008 and now, like you've got it for pretty decent price. Like using any of the affordability metrics, because what you see is if you just look at long-term history across different countries, your normal range in terms of value household price to median household income is around 3 to 7 is what I typically see across the board, right? So you're still within that normal range in the US, whereas in Australia, in Sydney at least, we're trading at 12.5 times that. So in terms of valuations, we're very much stretched compared to the US because in Australia, we haven't had a cleanse out. So we've talked about how housing markets typically have much longer cycles, 20, 30, 40-year cycles, compared to the stock market, which is like a 10-year cycle, 7 to 10-year cycles. And so in Australia, we haven't had a cleanse out at all. Like I don't even know if the Australian housing market ever crashed. So we're just going up and up and up and up. And I think, I don't know, we're reaching a point pretty close. I don't want to predict the timing of this or anything like that. It could go on for another 2 years, 5 years, who knows, right? But I think we're at a point where it's really stretched and we are due for a cycle pullback. So I think that's another key differentiator.
Yeah, I agree. I think if interest rates go up and if they're spending 60% of their income on the house and you have a variable rate interest rate loan, I would not want to be in that. Yeah, what I did was like the complete opposite. I bought the house when it was pretty cheap. Then my mortgage rates were pretty cheap. And then when they had the COVID, crash or whatever, I just refinanced and it brought my payments even lower. I was like, this is cheating. At least that's what I thought. I was like, why would someone give me a 30-year fixed rate loan when they're doing QE to hold the rates low? Like, I just thought that was absolutely insane. And I was like, wait until the inflation comes from all this. And then it was like, boom, inflation starts coming. I'm like, yes, inflate my debt away.
Yep, that's exactly it.
So another thing I wanted to talk about, and I'll share it real quick, is maybe we can talk about it a little bit.
Sorry, and
just
before we move on, like just before we move on, like approximately how much do you think, in the US, in your local area, how much do you think people are spending on new mortgages, like in terms of their like percentage, just rough calculation? I know we couldn't find the data, but like roughly, how much do you think people are spending?
I of the people who are getting homes,
yeah,
I would say it is very manageable. So I would say that the average mortgage over the past few years is probably between, and this is just the mortgage, no property tax and none of that. I think it's probably between $1,300 and $2,000 a month. And most people are putting down, I think the average is about 15% down payments. So if you're somewhere between that, and I think most people, they probably make, the ones that are getting the homes are probably between $70,000 and $100,000 is what they make. So if it's,
so that's nothing.
It's 20 something percent, maybe 30% at most is probably what most people are at with just the mortgage. And then they have taxes and other things on top of it. So
here's another question for you, right? So for those same homes, right, that you're paying 13, or do you say 1,300 to 1,500 in mortgages per month?
1,300 to 2,000, somewhere in that range.
2,000. Okay, so if you were to rent those out, how much would you get? Like how much would you get in rental income?
I would say between $2,500 and $3,500 in rent. So somewhere in that range. And I would say most of them are around the upper 2,000s.
Yeah, so that's another key differentiator between the US market and Australian market, right? Because I'll show you this chart again. But I've been saying here, so right now, I know so many friends that have that are making like $8,000 in mortgage repayments for their investment properties and getting $4,000 in rental income. So they have to chip in extra $4,000 to fill the gap between their mortgage repayment and their rental income. And this is what this is showing, this graph, right? So portion of the household income required to service a new mortgage is 60.4%. Portion of household income required to pay rent is 34.2%. So effectively, if you buy an investment property right now, your cash flow is net negative. Negative.
In California, it's like that too, with people who recently have purchased.
Yeah.
What happens is if you buy at the low when that's a good deal there. I had a friend of mine in college, his mom bought 4 rental properties all around San Luis Obispo. At that time, it was about $200,000 a house on average, but you could rent it out and cover the house, the cost of the house, because the rental, I mean, the rent prices were really high. They were like 2,000 something dollars a month or so. I think it was around there.
Wow.
And
Wow.
the property taxes get locked in, and they could only increase the property taxes by 2% a year. And I was like, oh my gosh, this is perfect. And my dad was thinking about buying one because he's like, man, that's really low out there. And now those same homes are $800,000-900,000, and their properties are the taxes are really low because they can only increase it by 2% a year. That would have been a really good bet. I know that
must have shot up as well.
What's that?
And rental income must
Oh,
have shot up as well. Yeah.
Oh, it's probably, I don't know what it is now. I could look, but it's probably around 3,000 or something or more than that.
Yeah.
But yeah. And I wanted to touch on what Kuppy wrote,
Sorry,
because
Ian. Go ahead.
Kuppy wrote an article, and I'm a pretty much a lone wolf on the housing bull camp. No one else is in the housing bull, but he says, he just wrote this May 2nd, in defense of housing. He's got, some of the data here, but one of the things I want to touch on is this. He says, I like to keep concepts simple here around here. Say there are 1,000 buyers who can afford a home when a 30-year mortgage is at 3%. Say there are 800 buyers at 4%, 600 who can afford it at 5%. Now realize that none of this matters because there are only 100 homes to fight for. This sums up the US housing market today. So the affordability, the affordability doesn't matter because the people who can't afford the homes are already being priced out of the market, irrespective of interest rates. And I just think that's one thing that he nailed here, which I've described in some of my other things I thought quite well, is that does the affordability even matter? Because we're pricing everyone else. The pricing is so far above where the interest rate's at that it doesn't matter at this point. And I don't know where that point matters. Like, I don't know what the breaking point is. That's why I want to watch inventory and see what it does every single month. And it'll impact it at some point. I just don't know when that point is. He talks about the demographic analysis and how this blows out. So we went to this is older age, and this is the home buying year age is about right where this start of the blue line is. It kind of comes down and then it fattens back out. This fattening back out is the demographic coming into home buying years. So we have more and more people coming into home buying years. And 34 years old is the average first time home buyer age. This goes all the way down to like in the late 20s. So we've got a good few years to come on up, and then it remains elevated versus, history. And then we've underbuilt. So it's a strong trend that's occurring. And then he goes into the US housing starts and permits, almost like he's watching the Finding Value channel. And we've got, obviously the permits are shooting higher and the starts are coming up. And we did some calculations where this home buying group, if you were to take an average of it, is really 1.8 million. So in order to work down the deficit of 5 to 7 million homes, depending on the figure that you use, you have to build above the 1.8 million mark to start working against the deficit. And we don't have the homes out there. And I know there's people who say that it's very popular. They put it on Twitter everywhere that we have more homes than people and that we don't have a structural shortage. The problem is some people own multiple homes, or some people own many homes. What is going to spur them to sell? Why would they sell? And that's the problem. The homes aren't for sale. People own them. It's not, what are we going to do? Go steal them, like take it from them and put it for sale? I hopefully we don't do that, but that's one thing that they argue, and I just don't understand that argument at all. And it says that this is a huge aspect that you had touched on too, Scott. What we just touched on with Australia. He says, I want to make it very clear. Real estate gets priced based on rental rates and cap rates. Rents have been skyrocketing because everyone seems to be getting massive raises. I don't have a single friend who didn't get a whopper in the past year. Offsetting this, cap rates probably increased with higher interest rates. The interplay of these two, especially when you start at a low single-digit cap rate, is hard to predict. I have no strong view on property prices themselves. I want to make this very clear. If prices were to drop, especially in the states that are seeing massive out migrations, I don't think it changes my thesis one bit. In the end, we need to be building well over 1 million new homes a year for a decade into the future. In fact, the analyst at NAR said that we could be building 2 million homes for an entire decade, just to catch it all back up. He says we need to be building he says for the decade of the future, just to keep pace with expected new family formation. We need to be building almost 2 million new homes a year if we want to make up for the lack of home construction over the past decade. I completely agree with that. That's exactly what I think it's Lawrence Yun of NAR had projected. He says, if I know anything about our democracy, both parties will trip over themselves to give first-time homebuyers all sorts of stimmies to take the bite out of interest rates. I'm long volume, not price. Let me repeat that again. Volume, not price. So he's long the volume of the new homes being built into the system. And the way that he's playing it is he's not investing in the home builders themselves. He's investing in the real estate supply chain. And the supply chains are going to be based off volume, not price. So price will push higher home starts, and higher home starts is volume. And that volume is going to be the way that he's playing it off the real estate supply chain. And the reason he's doing that is because margins can be compressed in the home builders. And that's why I'm always very weary of going into the home builders, because I think there's greater opportunities in energy and energy services and whatnot, but he's playing it through real estate supply chain companies. And he doesn't give any, particular companies in this area here, or in this, piece that he wrote. And he says, I'm fixated on volume over price, but have ignored the home builders. So that's what he's done there. Moving on down, it says, in summary, I'm tired of people asking why I have so much exposure to housing. I've now detailed my thinking for everyone. I sincerely hope that the sellers smack these names harder. It only makes the buybacks more accredited. They're doing a bunch of share buybacks, just like the oil sector is. I wrote stunningly large number in May and June puts. I hope the bears keep growling about mortgage rates. I want to assign. I want to max out this position even further. Despite housing now being my largest exposure, it's overtaken energy and uranium as I added aggressively into this dip. I want to press this bet even harder. It's rare that you see a macro trend that is this good, with this strong of a tailwind, with this much hatred on the street, despite insane valuations. I'm effectively long 3 trends that are rapidly accelerating: inflation, vote buying stimmies, and government insanity in blue states, leading to refugee crisis for red states. These are all trends that I can put my back into. When they converge on one sector, the housing supply chain, I cannot help but get piggish. So he is like ultra bull on the real estate market in America. And what's crazy is I'm an ultra bull in real estate because of the demographics and because of the housing shortages. So I am glad at least one other person has similar viewpoints, and Scott, I think Scott has a similar viewpoint, maybe perhaps as well. I don't want to talk for him. On American real estate, that it's very bullish because of the demographics. It's very bullish because of the 30-year fixed rate mortgages. It's very bullish because of inflation. It all is lining up. And what this is really lining up for, the demographics is going to push inflation into the system as well. It's going to create money velocity as well, because when you come into these home buying years, you're going to have increased spending. You're going to have they're going to get into their maximum spending years and maximum income years, all coming up over the next 5 to 10 years. So you have the largest demographic coming into, I'll call it life. They're coming into life where they have kids, they spend more on diapers and kids and clothes and food and all sorts of stuff, and buying couches and buying stuff for the house that they just purchased, and getting new mortgages, new cars, because their old cars don't fit this new family, on and on and on and on. And guess what? I have kids. I'm 41. I'm the oldest millennial, so to speak. I'm right on the edge. And I've got 3 kids and 2 step kids. So I have 5 total that I'm supporting. Well, 2 have basically moved out, but I've got 3 young ones. And then you have a family too. So you're going through that cycle as well. And it's like, wow, this is it's getting real with all of us, you know, having kids and supporting kids and spending. So I think everything's in I don't know, I think everything's intact. I think the trend is in place. And now it's just riding this big trend. So do you have anything
I
else
agree.
to add, Scott?
Yeah, no, I think the key thing for me is the key differentiator really is not just the affordability, but the fact that we've had a cleanse out in 2008. And it's just so important to remember that real estate cycles, I think, are on a much longer time frame. So, so that's the key differentiator. Like Australia didn't have a housing crash in forever. Like I don't even know if we ever had a housing crash. So that's really different, right? So once you have that cleans out, like fresh books on your new on your bank's financial statements, like it's a difference between night and day. So I agree. I wish I could actually maybe a pretty good bet I actually to play this is maybe long US housing and short Australian housing. That could be a pretty good bet because then you're like kind of hedged, but you could make gain even much further gains if Australian housing crashes. So maybe you could play it like that.
The only thing that I would say there that could go bad is the currency differentials. If you have a crash, your currency would get stronger in Australia and our currency would get weaker if we continued to pump out the inflation. That's the only thing I could see because the denominators.
Yes.
But overall, you're right. You could the prices would fall and these would go up. I agree with that.
Yep.
All right, so that's all I've got. Thanks for coming on, Scott. Guys, sign up to Sow and Reap Capital. Check out his website on YouTube. I don't know if you wanted to share anything else, Scott. If you had any sayings or anything like that that you want to also share.
I don't have one prepared actually, but yeah, just that God is love. God loves us, and He is love.
So there's this website right there, Sow and Reap Capital. Go ahead and subscribe if you think you want to listen to what they have to say. And we'll catch you next time. This is Finding Value, signing out.
Thank you.